Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. By the end of last week, there was a shred of hope that the worst might be over for 2022's massive rate spike. By Tuesday of this week, however, that hope was shredded. Things only got worse from there. To understand why, we have to revisit the general motivation for the rate spike. Before I do, let's put massive into context. It's not an overstatement considering that this is the biggest, fastest jump in mortgage rates since 1994. As for the why, it's actually fairly straightforward. The Federal Reserve is best known for setting the Fed funds rate, which dictates the cost of the shortest term financing. It raises and lowers that rate to try to persuade inflation and employment to remain in certain ranges. In cases where the rate is cut to zero and the Fed thinks more needs to be done, they buy bonds, U.S. Treasuries and mortgage-backed securities specifically. Buying bonds creates excess demand in the bond market, which in turn pushes longer-term rates lower. Basically a way for the Fed to influence both short-term and long-term rates. Now, at the start of the pandemic, financial markets were in chaos, and the Fed stepped in to cut rates to zero and buy bonds at a faster pace than ever before. Rather than dial back those bond purchases when markets began to settle, the Fed concluded that it should continue providing as much monetary stimulus as possible in light of COVID's impact on the labor market. Now, they justified this with the assumption that the COVID-driven inflation would subside as, well, the pandemic subsided. But as we all know, COVID-related inflation didn't subside. By the Fed's own admission, it drastically miscalculated the persistence of inflation and even the health of the labor market itself. As 2022 approached, we suddenly found ourselves staring down the barrel of the biggest inflation numbers and the tightest labor market in decades. Meanwhile, the Fed still had its Fed funds rate at 0% and was still buying more than $100 billion in bonds each month. Now, change was slow to come at first, and in September 2021, the Fed began winding down the new bond purchases, which is a process it needed to complete before hiking rates. A few months later, as inflation continued to surge and the labor market grew tighter, the Fed began accelerating its exit from easy money policies. But much like a battleship in a river. By early 2022, the Fed's communication spoke to a certain level of panic not seen since the 80s. The Fed does not like to make big course corrections once it starts to turn the proverbial battleship. But 2022 has seen those sorts of unexpected accelerations one after another. This rapid rethink and rapid removal of bond buying demand on the part of the Fed is the key ingredient to the rate spike seen so far in 2022. This past week merely brought the latest iteration. Specifically, in a prepared speech last Tuesday morning, Fed Vice Chair Brainerd, who is normally one of the most rate-friendly Fed speakers, joined a chorus of more hawkish Fed members who've been talking up the possibility of extremely large reductions in Fed bond buying, also known as normalization. This wasn't an entirely new concept, as the Fed is already on record saying 2022's normalization will definitely be bigger and faster than 2017, which is the only relevant precedent. That said, the market was surprised to hear it from Brainerd, at least in such emphatic terms. One of the reasons for the surprise was the fact that the following day, we would see the release of the Fed minutes, which is the most recent Fed meeting which was held 3 weeks ago. Fed minutes are often contain additional clues about impending policy changes. Traders correctly assume that there could be a bombshell in the current version. That went a long way towards softening the blow when the minutes actually came out. In a nutshell, the minutes laid out an explicit roadmap for normalization, whereas the Fed rolled out 2017's normalization process with a $4 billion per month hit to the MBS purchases. 2022's plan calls for a phase one to start at a staggering $35 billion per month. The discrepancy is similar when it comes to the Fed's Treasury purchases. Again, I knew it would be bigger and faster, but not quite this big or fast. Because the Fed bond buying targets longer-term rates, that's where I saw the pain after the minutes release. In other words, things like 10-year Treasury yields continued moving higher, while 2-year Treasury yields managed to recover. Now, mortgage rates care about 10-year yields because 10-year yields speak to trends in longer-term rates. In general, here's a chart to help you visualize. While longer-term rates also correlate with shorter-term rates, as you can see in the following chart, it's not quite the same. Short-term rates rise and fall faster and less often. Interestingly though, when short-term rates peak, relief typically isn't far behind for longer-term rates. Unfortunately, I've yet to confirm that peak. So many things are so different about this economic monetary cycle that past precedent may not be as useful as normal. All I really know at the moment is that I'm waiting for several key developments. The most important among those would be for the inflation data to show signs of shifting. That could take months though, and the bond market may have priced in an overabundance of caution by then. Now before that, I'm waiting to see what triggers the Fed at its upcoming meeting in May. Certainly, they'll be hiking, probably by 50 basis points. They're also likely to enact the normalization plan laid out in this past week's minutes. If that's the extent of the damage, then the market will finally be on the same page with the Fed. That means the rate hike and big reductions in bond buying could actually be a good thing for longer-term rates. It wouldn't be the first time I've ever seen such a paradox. Longer-term rates always do their best to account for future possibilities. If they know the Fed is likely to hike short-term rates or to normalize bond purchases at a certain pace, they're free to move on to their next trend. In several past occasions, I've actually seen mortgage rates move lower while the Fed policy was tight or tightening. So again, the only question is, how well have long-term rates priced in the future this time? It's only been the unexpected changes in the outlook that have caused so much extra upward momentum in rates. Once the outlook stabilizes, rates will probably already be coming back down. Unfortunately, there's no telling if that's the sort of thing that will happen in a few weeks, a few months, or in fits and starts throughout the year. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. So until next time, take care and stay safe.